Hey, Renter Retires. This is Adam Schrader, and I'm here for another episode. And I am once again joined by Zach Lemaster, CEO of Rent to Retirement. Zach, pleasure to have you back with us.
Good morning, Adam. Great stuff we're going to talk about today. A lot of, I think Robert Kiyosaki calls them chicken littles out there, talking about the sky is falling. The sky is falling, but nonetheless, we're going to go back to why the fundamentals of real estate always prevail and why this asset class has been around longer than anything else.
Yeah, so let's go into it. Are you, before we get started, are you going on with any contracts, any exciting real estate news on your personal front?
I mean, I guess we better be walking the walk if this is what we're out there preaching, right? I mean, absolutely. We're constantly buying. I mean, my mantra is always be buying, and try never to sell, but sometimes you do have to sell and transition your money. Yeah, we just went under contract yesterday, actually. We're doing the attorney red line back and forth, but assumed to be under contract for another commercial purchase. This is in Denver, Colorado. This is 2 buildings that or like commercial triple net leases, and AutoZone, Subway, Chase Bank, and Starbucks in one of them. Super low cap rate. There's like a 5 cap. The reason we buy these things, though, is cost segregation studies. And so this is really a tax play. And one of the most exciting things about real estate, in addition to that, we're doing more and more construction in Florida on a personal level. Of course, we're doing that for our investors consistently, and we're just constantly reminded about all the benefits of what Florida brings to the table. And so we just acquired a few more lots this week as well. Very excited about those.
Nice. Yeah, we're my wife and I are currently enjoying the delays of new construction and getting used to the patience that one must have when one does that, because our
patience, yes, absolutely.
Yes. I mean, patience, because we're now supposed to close in mid-November, and we're hoping that one actually sticks, because the closing date's been bumped back. Thanks, supply chain. Really appreciate it. So yes, folks, we are walking the walk. So let's get into it. Today, I want to start with this wonderful article, this horrifying article I found on CNBC, talking about how mortgage originations are going to drop 33% in 2022 as interest rates rise, according to an industry forecast. Now, this initial headline, if you're reading it, I mean, CNBC is obviously a huge news organization. Zach, this sounds horrible. What are we going to...
Better stop investing in real estate, Adam. I mean, what do you do? Again, this is what makes news, right? Yeah. I mean, if there's no story to be had if it's like, if we were to see a report about mortgage rates, continue on exactly where they are, interest rates, and everyone's doing completely fine. I mean, it's the shock factor to this. I mean, I look at this and, just turn the page because it doesn't really matter to me. Again, we look at the fundamentals of investing in real estate, looking at, are interest rates actually rising? I don't know. I've heard of, other studies about the Fed wanting to try to keep them low through 2023. Who knows? I mean, yeah. if they rise, is that going to impact, prices to some extent? Potentially, probably at the higher end. I mean, I always try to look at things like this, take it with a grain of salt, and then translate it to what does this actually mean? What does this mean for our investments on the type of properties we are buying?
Yeah. So let's dive into it a little bit to see what on earth they're talking about and if it is terrible. So first off, they said that rising interest rates will result in a sharp drop in refinance demand in 2022. Well, anybody who knows anything could have told you that. I mean, we're not going to see another refinance boom like 2020, 2021 for maybe ever. I mean, meaning a lot less business for mortgage bankers. It predicts total origination volume to drop 33% to 2.59 trillion. But what they don't mention, and what they talk about later in the article, is that originations for the purpose of buying a home, however, are forecast to rise 9% to a record 1.73 trillion. Now, I may not be the smartest man in the world, Zach, but to me, it seems that if more people are going to be trying to buy a home, that is more useful to know than less people are going to be taking money out of their primary residence. Wouldn't that seem to be important?
Well, I mean, that just, I think, goes to show that the real estate market is going to continue to heaten up, right? I mean, there's going to be more and more sales, less refinances, which is a fantastic thing, by the way. If we look at how bogged down the lenders were over this past 18 months with refinances, it inhibited the investment loans. the feds actually came in and regulated the Fannie Mae Freddie Mac loans to all investment banks, and this was a big issue for us, and it was very frustrating. The banks could only hold a 7% of their total loan amounts in investment purchases. You know what I mean? And because they were also doing many investment purchases, but anytime the Fed tries to come in and dip their hands in and control something, it has a negative impact. And so that increased rates for a short period of time. Just recently, that has now gone away. And I think that also having less refis opens up more opportunity for more competitive loans on the investor side. I think that's a good thing. But absolutely, I mean, to your point, Adam, if we're seeing people that are projected to have more people actually purchasing real estate, for primary resident or investment purchase, that's going to be all the reason to continue the trends that we've been seeing, over the past really 6-10 years, whatever.
Yeah, and we could see, I mean, the lack of refinance could lead to, potentially slower appreciation. But I mean, even at the appreciation rates we've been seeing, slowing down isn't going to hurt anybody. I mean, we've been seeing monstrous, appreciation in a lot of the markets that we're in, and then you've seen it nationwide. So, if people stop pulling out all the money, even if it slows down, even if it halves, you're still at a very, very good rate as opposed to what we've been seeing historically. So I don't think I just wish I'm a person personally, I'm an optimist. I wish they would lead with more of the more people are still going to be trying to buy homes, but that's not the world we live in, I don't believe.
That's not the shock factor. And again, to me, doesn't matter, right? We're investing for cash flow. You're looking at the fundamentals of real estate. We're not talking about inflation today, but we're going to see a ton of inflation. We're already seeing that, with the supply chain issues. Just everything that you're buying is going to increase. Consumer goods have, there's been an exponential increase in consumer goods for probably multiple reasons over this past year, also causing inflation. That's a good thing when you're holding real estate, right? I mean, real estate is one of the best things to mitigate your exposure to inflation, but even better than real estate is debt, good debt that's worth less in the future because you're buying with today, you're borrowing today's dollars. We did the interview with Aaron Chapman, where he actually showed an example where you're paying less than you're borrowing in the future if you hold the loan for a long period of time, because of what inflation is doing. Plus, inflation causes appreciation, rental increases over time. All this that we're looking at economically is just even more reason to have your assets in real estate, which more and more people are realizing today. I mean, that's why we have so many investors purchasing real estate, is people are also getting skeptical of the stock market at being at all-time highs. I mean, that's a scary thing, right?
Oh yeah, and what I love is one of the reasons that I just kind of laugh is people look at the stock market as this great way to make money, fortunes, all of this. And then I think, they're so excited when they see that the stock market historically has averaged a 10% return, per year over the last 80 years. Well, first off, if you break it down by decade, it's like flat, flat, negative, negative, flat, flat, 200% or whatever. And I'm like, you realize that even just like cash on cash return for real estate, you're doing 10%. And that's before you factor in all the other stuff. Like if you just look at your cash on cash, you're getting better than you would in the stock market. So remind me again why, and you can't leverage yourself. So remind me again why you're so fantastic, investing in the stock market. But that's
Well, and not to poo-poo on those people too much, obviously we're very biased, and I don't do any stock investing, but it's also a little bit more, especially when we're talking about 401ks and things like this, and having someone else manage your money. You can just be complacent, right? It's actually more passive, which is not necessarily a good thing. Real estate takes time. It takes time for education. You got to be more actively involved. But by doing that and being more educated and involved, you're able to, create an actual financial blueprint and achieve much better returns with a plan.
Yeah. So the next thing I want to move on to is this article I found on USA Today, where it talks about the share of income being spent for each generation when they were 25 years of age. And the reason I wanted to get into this was because we're starting to see, millennials are becoming a bigger and bigger part of the home buying world. We're seeing that. I mean, obviously, as millennials are getting older, I'm the oldest millennial you can be, I believe. And but when you look at it, you see that over time, from young boomers to young millennials, there is a massive increase in the amount that they're having to spend on housing. I mean, it's 6%, but if you look at it, that's 1/5. That's a 20% increase, over 2 generations just in housing expenses. And I want people to remember, looking at this, younger millennials are spending 35% of their income on housing. You're considered rent burdened at 30%. So this is a continual trend. I mean, even older millennials, 34%. You're rent burdened at 30%. That's a significant increase. So these are people that they're trying to get in the housing market. They are coming into the housing market, but a lot of these people, even with millennials buying homes, they're still going to need to rent because guess what? They can't save up the money. They still can't. I mean, as rents continue to increase and wages are slowly catching up, we're just seeing a fantastic market for landlords.
Yeah, I think that we can look at a handful of different studies, just even psychologically for millennials, and apply that to the housing market and what we're going to likely see in the future. All trends kind of point to millennials not really being so, I guess, invested in or having the idea of actually owning a house is not one of their top priorities. And so this probably leads to them running through longer periods in life. Getting married and having children is less of a priority. It's delayed to later in life as well. So I mean, people will likely rent for longer periods of time in their life as home buying is less of a priority. And
Yeah.
absolutely, as a landlord, that's a good thing. That increases your rental pool. Also, at the same time, we have the baby boomers that are looking to transition out of home ownership, right? And so it's kind of both sides. We're seeing a huge increase in rental demand.
Yeah, this article continued and it really showed, I think even millennials who buy will be coming back, because this one blew me away. It said 25% of younger millennials said they compromised on the condition of a home, the most of any group according to the National Association of Realtors data. What we do see is that millennials as home buyers are actually purchasing older homes that need a little bit of work. It makes it more affordable. And let me tell you, Zach, I believe if you are buying a home that needs a lot of fixing up, that is a very good way to never want to buy another home again.
Well, I mean, this kind of goes to show you someone that is buying a house that maybe doesn't have a lot of homeownership experience, because that can become very burdensome. I mean, if you have a lot of time and also money too, right, to put into fixing up a house, it can be a great way to invest, of course, doing the value add and increasing it if that's
Yep.
your exit strategy. But if you're a busy professional and you're buying an older dilapidated house because that's just the only thing that you can purchase, which is probably truly the case in a lot of the coastal, very expensive markets. It's going to be a wake up call when you have to put in a significant amount of money and time to do repairs. And again, that just reinforces the fact of a lot of people probably will use that experience as their first home ownership experience and probably decide that's not for them.
Yeah, I can see a whole lot of people on this. I mean, if I had had to, with our first home, come in and spend an unknown amount of money and time to fix it up, especially with a lot of millennials right now waiving inspections and appraisals and everything just to get a home. So they're going in, not only do they know it needs work, but they don't even know how much work it needs. I can see a massive flood back to the rental market in, 5 years, whenever they decide it's time to leave the home that they're living in now. So just wanted to touch on that. It's not something that, I mean, we talk about millennials buying, but we haven't talked a whole lot about what millennials are actually buying. And it turns out what they're buying may not be the thing they actually want to live in.
There's another study that we saw, and I think Sam presented on this, but and I forget the exact statistics, but there was a crazy number of millennials that their first home purchase before they actually bought their own primary residence was an investment purchase. Which is interesting to show, because that's actually even harder to qualify for. However, the home purchases that they were making were not in the same location that they were living. I mean, this is right up our alley with what we do, right? Investing
Yep.
in areas that are more affordable. So they were taking $20,000, which wouldn't, potentially could have got them into a property locally that they would have as a primary residence, but they were taking that and investing in a property in the Midwest or Southeast that they would actually produce income on. So at least I think that also goes to show there's a little bit of education and savviness in the real estate industry. And because we're, in the information age and there's so much education out there available, people are taking it upon themselves to educate themselves about investing in different asset classes. And so that was actually a very cool thing to see.
Yeah, that is. And I was actually, when I was looking at that chart that I showed earlier with all the percentages, one of the things that you saw grow was the amount of money they spent on education, which is no surprise to anybody. So I was just curious, and I looked up, what is the average student loan payment per month, and I found it was $393. So then I went on to a mortgage calculator and I thought, well, what is that? So every month, just principal and interest of $393 in today's environment will get you roughly a $90,000 property. So these people every month are paying for their student loans by paying the mortgage of a $90,000 property.
That's a great point about, and I love that. We have this discussion all the time, right? It's about what is the best application of your capital. Pay off debt, make an investment. Pay off debt, make an investment. What do you do? And I always was, of the opinion that you buy assets to support your liabilities. Obviously you need to balance your debt, right? And if there's debt with extremely high interest rate, that's hard to overcome. But shoot, man, if you have an interest rate, even on a car, I love using the car example, because if you can get an interest rate at 3 or 4% on a car, versus paying cash, wouldn't it make more sense to take that same $50,000 instead of buying a car all cash, actually take a loan out on it, buy 1 or 2 houses that are going to cash flow more than your payment on the car, and then when it's all said and done, the car is paid off. You're using the cash flow from the house, but now you have a physical asset that's cash flowing, that's also appreciated over time, paid the loan down, things like this. So, obviously everyone needs to look at their financial picture, but sometimes maybe paying off loans isn't in student loans as well. If there's a lot of forgiveness programs coming available, maybe that's something to consider as well.
Yeah, I think my favorite paying off debt story of my own was when we had the twins for our third and fourth kids, we had to buy a minivan. And while they get bad raps, it was a very good time to buy a minivan, because we were able to get a 5-year loan at 1.9% interest. And my wife doesn't like having consumer debt. And so after a little while, she was like, God, the balance is low, we should just pay it off. And I said, Aaron, we have a 1.9% interest rate. Our money in the bank is making 2.2%, because at the time interest rates at the bank were higher. So we are making money not paying off our car. If we were to pay it off, we lose. Not a whole lot, obviously, but there are times where paying off your debt just doesn't make sense.
Plus, the further along you get into that loan, the amortization scale, it's mainly principal payments at that point. You've already paid your interest, the majority of it. So why not just write it out,
Yeah. So the final article I wanted to talk about before we get into some actual properties is this, another one from CNBC. Today's tight housing market is already overbuilt, one analyst says. And this one got me curious, because I thought to myself, we've talked about how Fannie Mae has told us there's a 5 million home shortages. We're not building that quickly. So I thought, what is this guy talking about? What does he know that I don't? What does he know that everybody doesn't know? And so his thesis was, and that the demographic shifts are leading to a slower population growth. And the chief economist for the National Association of Home Builders responded and said, I've seen his thesis and do agree population growth is slowing. And that's a reason why the old normal combined single family and multifamily construction of 1.8 million starts per year is too high. But I would like to note for everybody out there, we are nowhere near 1.8 million starts per year. We are currently on pace for about 1.5. So all of this talk about how we're going to need fewer homes from a couple of people out here, just maybe it's true, but it's already coming true. We're already building less than that old normal that they talk about here of 1.8 million. We haven't been at 1.8 million much in the past 10 years. I think 1.8 million was closer to like 2004 levels or so. During the pandemic, we dropped all the way down to 800,000 annualized starts for a little while. Now we're at, I believe it's 1.5, 1.55 last I saw, somewhere in there. So when you hear this, people need to realize the new normal is still what we were seeing in the past. We're still building too few homes. It's incredible to me that you have analysts out there, and there may be some parts that are overbuilt. Maybe if they're still building like crazy in markets that are seeing people flood out, yeah, that's bad. That's not going to be good for anybody. But nationwide, we are not at a level where we're overbuilt. We have a huge gap to fill before anything like that happens. So just
I think there's a very sectoral kind of approach into, just trying to kind of make a bold statement about the prediction of where the housing market is headed. And I think this is obviously ignoring a lot of very important variables. Also, we want to look at, geographically speaking, specific areas. Obviously this is a nation as a whole. Population is still growing, albeit at a lower growth rate than probably previously, when everyone had 5 or 6 kids to help with the farm, or had them with 10 kids in the minivan. And it's just a very sectoral approach. So I can only speak to what we're actually seeing, and the markets that we're focusing on. There's an extreme housing shortage, right? Cape Coral's an extreme example of this. Florida, with 1,000 people there moving a day to Florida, there's an extreme housing shortage. There's houses on market have an all-time low as far as how many houses are on market and the days on market. We can't build enough houses to keep up with the demand there. There's a wait list for people to rent and to buy. So there's a population shift in addition to just population growth as a whole, and different areas are going to have different population trends. And I think generally what we're seeing is, we can't build to keep up with the demand.
And there's one final part of this article I wanted to show people so that we could move into our final piece. And that is this. It's a line from the article that said, if the market is already overbuilt, that would present even bigger problems for home prices, which are most definitely overheated. And I read that and shook my head, because you can't say something's overheated just because the value has gone up, just because the price has gone up. We've talked about this before on the show, and I will continue to harp on it. There is a reason things are going up in price. We've talked about it before. There's low inventory. There's people moving. There is a reason that home prices have gotten heated up, that they're rising, and there's a reason they will continue to rise. And eventually there will be a reason that they stop rising so much. But those reasons for it to slow down haven't come yet. They're nowhere near coming. So you hear a lot of people out there say the housing market is too hot, it's too high, because there has been a run-up. But run-ups do not equal bubbles that are guaranteed to burst tomorrow. If you want to look at homes that are built that are overheated, Zach was just talking about one. Let's look at a build that's going on right now, a build that you could get with rent to retirement. There's this one. This is in the Cape Coral area. You can buy a property for $274,900. That is, at this point in time, $125,000 lower than the average home price in the US, which is incredible. It can rent for expected current rent is $2,195 with an expected monthly cash flow of $578. Now, if you can get into a build-to-rent property for $125,000 lower than the average price of a home in the US, I think that's a pretty good deal. I don't know about you, Zach.
Yeah, absolutely. There's two things that I can consider, or when I get the question about where's the market is, people have been talking about a market crash for 5 or 6 years, right? It comes up all the time, and it's like, to me, it's irrelevant. You invest for the fundamentals. And real estate is always a good investment if you're investing for the fundamentals. To your point, there's two things I consider. One, yes, you want to invest below the median home price, not only nationally, but for a specific area geographically in Cape Coral. The average home price, I think, is about that $340,000, $350,000 range. So this is right around $75,000 below what the average home price would be for this specific area. So you're still below that median home price, meaning you have the largest demand and the largest buyer pool for this type of house. Additionally, and with these specific houses, they usually appraise in that same range, 340, 350. So you're actually coming in with a significant amount of equity. The other fundamental I always look at is making sure that the house is going to have rental demand and positive cash flow, which obviously we can see here. If I think this is ran with a 20% down conventional mortgage, when we're estimating these numbers. And so you have a positive cash flow that's going to support the property. And in that regard, it doesn't matter if the market fluctuates, as a crash goes up, goes down, as long as you have a tenant in place there, and all real estate will go up over time, and your actual return will be just as expected. And we do know that there's a huge rental demand in Cape Coral.
Yeah. And even if you believe, 275 is too much, Florida is scary. How about you go to someplace like Indianapolis? You can buy a property for 144,000, which, let me guarantee you, you will not see people building new construction, or much, maybe 5 or 6, that you can buy for 140,000. We have some in Memphis that come up sporadically, but for the most part, you cannot build this home anymore. $144,000 home, expected rent of $1,175 with an expected monthly cash flow of $337. It doesn't matter how hot you say the market is, you cannot build this home anymore. I just don't think it's possible.
And that's one thing we look at actually as a metric, and it's important to know, especially on the commercial side. You're in a good spot and making a generally safe investment. Obviously, there's other criteria to consider, but when you are below the rebuild cost, that is what gives that home value and security in that value. That makes a lot of sense from an investment price. And when you're looking at insurance too, I mean, you actually have to tell the insurance companies, I want to insure just for the value of what I'm acquiring the property for. They may give you a $400,000 rebuild, insurance policy. That's crazy. But that just makes complete sense. If you're buying below rebuild cost, that's a pretty safe place to be. Especially now, if this house was a dilapidated house that had no work on it, obviously have to factor that in. But with our properties that are having renovation done, you're expected to have little maintenance, little capex over time. That's a safe place to park money, in my opinion.
Yeah, absolutely. So I just wanted to point out these properties because, hey, even if the market is overbuilt everywhere else in the country, if you can't build it, then it's not overbuilt. It's a lot safer than people are out there believing. So, Zach, I wanted to thank you for coming on with us once again. Everybody, go check out renttoretirement.com. That's renttoretirement.com. You can see all the inventory we have there on the site. If you have any questions, please reach out to us, podcast@renttoretirement.com. That's podcast@renttoretirement.com. We will answer any questions, either send you an email back with the answer or cover it on one of the future podcasts. And we'll see you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.